Hello and welcome to this presentation. Today we are going to have a look at events after balance sheet. Now, events can be favorable or unfavorable events, and these occur between reporting date and the date that the financial statements are authorized. So if we draw a timeline, it starts from our year end and up to the date that our financial statements are authorized. And this date that our financial statements are authorized will be the date that the directors authorize the financial statements, or it will be the date that management authorizes the financial statements to be issued to the supervisory board, because sometimes the supervisory board must first approve the financial statements. So this period between year end and date authorized is our event after balance sheet period. So when we refer to events after balance sheet, it's any events that occur during this period. Now, there are two types of events that could occur. The first one would be adjusting events, and adjusting events relate to events that provide evidence of conditions that existed at year end. So, in other words, items that are already on the financial statements or certain conditions that are already present. For example, maybe there's a pending court case. The next one is non-adjusting events, meaning that no adjustments will be made in the financial statements. This happens when the events indicate that certain conditions arose after year end. So as you can see, when it comes to adjusting events, it's conditions that existed at year end, whereas non-adjusting events are any events relating to conditions that arose after year end. So in other words, within this event after balance sheet period. So when it comes to the adjusting events, we said these are events that provide evidence of existing conditions at year end. So this is where adjustments must be made in the financial statements to reflect any adjustments that are needed against assets or liabilities. Now, examples where this would be the case include things such as the resolution of a court case after year end, confirming an adjustment to a provision, or even the disclosure of a contingent liability. So, what could happen is at year end, there could be a pending court case for which the outcome will only be known after year end, and if that outcome of the court case falls within the events after balance sheet, then the company would have enough information to correctly either provide a provision or disclose the contingent liability. Next, any information after year end that an asset was impaired at year end. So again, this asset did exist at year end, but maybe due to sudden changes in the economic environment or even to the asset, there could be sudden impairments, and to reflect that asset at full value and not to impair it would not faithfully represent the financial statements, and therefore the impairment would need to be taken into account. An example of this would be the sale of inventory, where there is evidence of the net realizable value being lower. Or the other alternative would be where a customer, a debtor, went bankrupt and the entity will not be able to recover the full amount owing from that debtor, which means that the trade receivables would have to be restated. The next one could be cost of assets that have been purchased, as well as proceeds from assets sold before reporting date. any determination of profit sharing after the reporting period, as well as bonus payments, and if there is any discovery of fraud or any errors that are showing on the financial statements. Now, if the company is aware of any fraud or error, these need to be taken into account before the financial statements are authorized and before they are issued to the public, because once again, it's important to have assets that faithfully represent the information, and that information must be relevant. So let's have a look at an example. So here we have ABC Limited, and the financial year end of ABC Limited is 28 February 2020, and the financial statements will be authorized by management on 30 June 2020. So that means that the event after balance sheet period is from the 28th of February 2020 up until 30 June 2020. On 21 March 2020, so as you can see, it falls within our event after balance sheet period, GG Limited, one of ABC Limited's trade debtors, with an outstanding balance of 65,000 Rand, was declared bankrupt. No allowance for credit losses were made at reporting date in respect of GG Limited. The liquidator informed ABC Limited that they would only receive 50 cents in the rand. Now, very important, when you read something that says receive 50 cents in the rand, it means that for every 1 rand GG Limited owes ABC Limited, ABC Limited will only receive 50 cents. So in this case, we have a condition that exists at year end. The condition being the balance of 65,000 Rand that GG Limited is owing ABC Limited. So because there is a condition at year end that exists, and now we received new information about it, we need to adjust for this new information. So we need to bring in this adjustment to take into account the fact that that full amount will not be recovered. We need to impair our debtors. So half of the amount must be written off because ABC Limited will only be receiving 50 cents for every rand, and therefore this will be allocated to the credit loss allowance. Then, if we have a look at our non-adjusting events, these are events that indicate that certain conditions arose after year end. And in this case, no adjustments will be made in the financial statements. Examples of this include items such as a decline in the fair value, as this normally reflects subsequent circumstances. So fair value can change month to month, year on year. There is no set amount when it comes to fair value, and therefore a decline in fair value 2 months after year end would not necessarily be something that you would adjust for. However, there could be items that are non-adjusting, but we would have to give additional disclosure because these events are quite material and they would affect users' decisions, and therefore you would need to give them this bit of information even though no adjustments will be made. So the first one is a major business combination after reporting date. Now, as a user of the financial statements, you would want to know any major businesses that have been acquired or that have happened or combinations that have occurred after reporting date. Also, any announcements of any plans to discontinue operations, major purchases or disposals of assets or expropriation of assets, the destruction of major plants by fire after the reporting date, any announcements or commencement of major restructuring of the entity, major ordinary share transactions, abnormally large changes after reporting period in terms of the asset prices, and if there were any tax rates or law changes after reporting date, and if these had a significant effect on the current and deferred tax. And then our last example is any significant commitments or contingent liabilities that were entered into. Now, as you can see, all of these things that have been mentioned would affect a user's decision if they had to get this information. And therefore, even though no adjustments would be done because most of this has happened after reporting period, additional disclosure must be given so that users are aware of all of this information as this could affect their decision. Right, so if we then focus on a few specific items when it comes to events after balance sheet, for example, dividends. Any dividends that are proposed or declared after year end will not be adjusted for. Okay. In terms of a going concern, if information comes forward during this event after balance sheet period and management intends to liquidate or cease trading because of this information or because of something that has happened, then an adjustment will be required because the going concern changing is a really, really big issue. And users of the financial statements would want to know whether or not the company will be continue trading. And in this case, if the company is going to cease trading or liquidate, it cannot be prepared on the going concern basis. A new basis must be used on which the financial statements must be prepared. So, an adjustment will definitely always be required should a company have disclosed all the information based on the going concern basis, but this changed after year end and they intend to actually liquidate or cease trading. So in this case, we would definitely need to do an adjustment as well as have some additional disclosure. Now, the additional disclosure requirements include the fact that the statements will not be prepared on the going concern basis. It must be stated in there that it's not prepared on the going concern basis so that the users are aware of this. It must also state what basis has been used to prepare the financial statements, and then they also need to include the reason why the entity is considered to not be a going concern. Then if we get to our disclosure of events after balance sheet, very important, the disclosure that's required is the date that the financial statements are authorized for issue. And included with this would be who has authorized the financial statements and does anyone else have the power to make any changes to the financial statements. Next, would be any update to the disclosures with information after year end, which relate to conditions that existed at year end. Then, very important, we mentioned that you could have non-adjusting events, but sometimes these non-adjusting events would affect the decisions of the users of the financial statements, and that this information would be disclosed. Well, very important is that we do actually disclose that information, and in terms of the disclosure, the nature of the event would need to be disclosed as well as an estimate of the amount would need to be disclosed so that users have enough information to make proper decisions regarding this non-adjusting event, but that they have enough information to have a good idea of what effect it has on the financial statements. So if we now have a look at an example, we are going to continue with our previous example of ABC Limited, but we're going to add two extra points, number 2 and 3. And these points, number 2 states that on 15 April 2020, inventory with a value of 40,000 Rand was destroyed when a storage unit was burned down due to an electrical fault with a light switch. And then the third point says that on the 1st of March 2020, the directors declared a dividend of 20 cents per share for the year ending 28 February 2020. And as at 28 February 2020, the total shares issued were 100,000 and the authorized shares were 200,000 rand. Sorry, 200,000. Now, very important, whenever you want to calculate what is the total dividend that was paid, you're going to use the amount per share, so in other words, 20 cents, and then you need to look at the total shares issued because those are the shares that are actually held by the shareholders. So in this case, 100,000 shares are held by shareholders. The authorized shares being 200,000, that is how many shares the company may issue out over time. So they may not have more than 200,000 shares issued. Okay, so that is the total amount of shares that they can issue, but they have not issued. Those are just authorized shares, but the total shares that are issued is 100,000. So those are the amount of shares being held by the shareholders. So if we have a look at the required, it states that we need to disclose the above information in the notes to the annual financial statements of ABC Limited for the year ending 28 February 2020. Now it tells us which notes are required, so we know that we need to prepare the profit before tax note and the events after balance sheet. So now before we actually start with the disclosure, let's just go through the information that we were given in the question, as well as making sure that we understand what is required. So we know that we have three items that are events after balance sheet, as we have the debtors, the one debtor who was declared bankrupt, we have the inventory lost in the fire, and we have dividends declared during our events after balance sheet period. Now we need to distinguish between adjusting and non-adjusting events. Now remember, adjusting events are events where further information has been obtained regarding an existing condition at year end. So if we think of our trade debtor did exist at year end, and the chance is that that trade debtor was already impaired at year end because they have been declared insolvent, they've gone bankrupt, and this is not something that suddenly happens in a month. So that condition would have existed at year end. If we have a look at our non-adjusting events, these are events that indicate that the condition arose after year end. So the inventory was lost in the fire after year end because this fire only occurred after year end, meaning that at year end date, that fire was still, that inventory was still part of our trading stock. So we still had that inventory on hand. It's after year end that this fire occurred and the inventory was lost. And the dividends were also declared after year end. So, however, these two amounts, even though they've occurred after year end, they are quite significant and they will affect the user's decisions, or they could affect the user's decisions, and therefore we would have to provide additional disclosure regarding these two items. When it comes to our disclosure, we've been told which notes are required, so we know that we need to disclose the events after balance sheet notes, and we also know that we need to disclose the profit before tax note. Now, before we go and prepare those notes, let's just think a little bit about this and ask, are other notes affected by these transactions? So, in short, yes, we have our accounting policy notes that we would have to disclose. Any trade receivable notes would have to be disclosed. Inventory notes would have to be disclosed, but we are not going to disclose them because the required specifically told us which notes we must disclose. So even though there are other notes affected by these transactions, we are only going to disclose events after balance sheet and profit before tax notes. So if we now have a look at our disclosure, we start with our profit before tax note. And we know that we had a trade debtor who went bankrupt shortly after year end. So we need to impair that debtor. We need to bring into account a credit loss for that debtor, but it will be for the amount that will not be recoverable from the debtor. So the liquidator informed us that the company would only recover 50 cents for every rand that the debtor owes, and therefore the total balance of 65,000 we are going to multiply by 50 cents, which gives us a total amount of 32,500. So that is going to be our credit loss for that debtor because it's not going to be recovered. Then, if we come to our events after reporting period, there are dividends declared. And when it comes to dividends declared, we need to inform the users of the financial statements about dividends that are declared after year end, but before the financial statements have been authorized. And this falls within the period of events after balance sheet. So we need to inform our users of the financials about these dividends that have been declared. When did it happen and what is the amount? So on 1 June 2020, the directors declared dividends of 20,000 Rand for the year ended 28 February 2020. Now, the 20,000 Rand we've calculated by taking our 20 cents per share, multiply by 100,000 issued shares. The next thing we need to disclose is the inventory that we lost in the fire. So on 15 April 2020, inventory with a value of 40,000 Rand was destroyed when a storage unit was burned down due to an electrical fault with the light switch. So as you can see with both dividends declared and inventory, we are informing the users of the financial statements on what day did this occur, what is the amount involved, and then we're also giving them a bit of background relating to it. We're not just saying inventory of 40,000 was destroyed, how was it destroyed, and so the users have enough information to make decisions.